And so differential analysis is the big key is identifying the differences. And so the textbook shows you a methodology in accounting for differential analysis. And so differential analysis is broken up into different revenues, right, and expenses or costs. Okay. And so when we're looking at revenues, right, really what we're doing is we're looking between two different options. Option A and option B. Not very good A. Okay. And so the difference between option A's revenues and option B's is what we call differential revenues. Okay. Now, we then compare that between the differential costs. All right? And so again, and the key point of this is to make sure that you do option A and then option B, okay? Which just means don't flip-flop those things, all right? And so the difference between option A's costs and option B's costs gives us differential costs, all right? Okay. Then, all right, we're going to subtract differential revenues and differential costs, and we're going to end up with differential income. Okay. This whole process is called differential analysis. All right, so yeah, we accountants are not very creative. All right, differential revenues, subtract differential costs, give you differential income, and that's called differential analysis. And so I personally, this is the way I learned how to evaluate these things, and I personally like this better, all right, than the way that they show us in the textbook, because they get into these negative incomes, and it just confuses me, to tell you the truth, all right? And so the rule is, all right, if you have a positive, so if positive, all right, select or choose option A. Okay. So if that number is a positive, choose A. Guess what if it's negative? That's right, you choose B. All right. And so I personally, this is the way that I like it. All right. And so what I wanted to do is, using this methodology, highlight some of the decisions that a business might make when it comes to decisions that they need to make. All right. And so the first one I want to work, all right, I want to work PE 25-1A. This problem basically says Duncan Company owns a machine with a cost of $75,000 and accumulated depreciation of 15. All right. And so we have equipment, 75,000. Okay. Accumulated depreciation was 15. That gives us a book value, all right, of $60,000. All right. And so we have this asset that's valued on our books for $60,000. All right. And we have two options. Okay. Option A, okay, is that we can sell this, all right, for $54,000 less a 5% commission, right? Or we could lease it, all right, for 3 years for a total of $60,000. However, at the end, there's no residual value, okay? In addition to repairs, insurance, property taxes that would be incurred by Duncan if we would, lease it, is $85,000, right, over 3 years. Prepare differential analysis for February 21st as to whether the company should lease, alternative 1, or sell, alternative 2, the machine. All right, and so there's several things that you need to understand. All right, there's a terminology here called sunk costs. Right? Sunk costs are derived from decisions that have already been made. Okay? you can't go back and unbuy this piece of equipment for $75,000, right? We've already spent that money, right? It's already sunk, right? And so in this scenario, this $60,000 is a sunk cost. It is not relevant to our decision making. Right? Does that make sense? Okay. I want you to know that it's also a not relevant because it's the same. All right, it's the same whether we do option A or B. Okay, we you know we're not going to have this asset, right? If we sell it, we don't have it. If we lease it, we don't have it. Okay, and so therefore, because it's the same scenario, okay, it's a non-issue. However, okay, if we were to follow, and why don't we just go up here and use my table because I already created it, save us some time. All right. So the first option says, hey, we could flat out sell this machine. Okay. For what is it? The company can sell it for $54,000. So if we sell this, okay, we can get $54,000. However, if we lease this equipment, all right, we can get $60,000. And so we have differential revenues of $6,000 negative, right? Okay. Then, all right, it told us that if we sold this, okay, we're going to have a 5% commission, right? And so if we sold this, we're going to take the 54,000 times 0.05, okay, and that comes out to be 2,700, okay, or the 54 times 5%. Okay. Then, all right, if we leased it, all right, we're going to incur $85,000, not $85,000, $8,500, which would then give us $58 negative. All right. Okay. And so, it's kind of weird, when it's set up in this way. Truthfully, if I had my druthers, all right, I would have flip-flopped those. Actually, yeah, they presented it this way, but then they actually say, alternative one would be to lease, right? And alternative two would be to sell, okay? Which would have made this a little bit easier, all right? Because really what we have here is a double negative, all right? Because we're going to be subtracting a negative number, all right? And so in essence, we're adding that, and we come up with a negative 200, okay? And so in this case, we're going to do B, right? We're going to lease this. Because it's a negative, we're going to lease it. Does that make sense? In the textbook, all right, when you look at this problem, unfortunately, I didn't read the last paragraph, all right? Because I set this up in the way that they presented it. This they sold, all right, and leased. Sold and leased. The truth is they, you could have just, with using your common sense, you could have probably just looked at this problem and said, yeah, I'm going to go ahead and lease this thing, all right? Because, I'm getting $6,000 more, from the revenues, okay? And, yeah, the expenses are more, but still, I'm going to make $200 more if I lease this versus selling this. And so, so we're going to take option B, we are going to lease. Right? But the point I was trying to make here is that a lot of these things, if you understand the terminology, you don't actually need to fill out this differential analysis format. Okay? You can just pretty much, using some common sense and understanding of the definitions, right, and using some of the rules, all right, you can actually figure this out without doing a table. All right, you can actually just crunch the numbers. All right, and so I'm going to highlight that was up there. All right. Let me choose another one. Okay, so what did we learn in this problem? We learned and understood, hopefully, this concept called sunk cost. Next problem I want to do, all right, is this thing called the discontinuing of a segment. All right, and so we're going to do PE 25-2A. And in this one, it says product alpha has revenues of $545,000. Variable cost of goods sold, $400,000. Variable selling expenses of $65,000 and fixed costs of $90,000, creating a loss from operations of 10. All right, so if you took the revenues, subtracted all the expenses, you end up with a $10,000 loss. All right, this company is losing money. All right, and so the question is should we just stop doing this? Well, you need to understand that this scenario is a do or don't do. All right, so looking at the revenues, all right, option, okay, 1, revenues. Let's do option 1, do and don't. All right. Costs, do and don't. And differential income. All right. And so in this scenario, it says, hey, if we were to produce this, all right, we're going to incur revenues, all right, of $545,000. Right? If we discontinue this segment, product alpha, okay, we're not going to have anything, are we? And so we have differential revenue, right, of $545,000. So let's look at the costs, all right? If we do this, okay, we're going to have variable cost of goods sold, all right, of $400,000. If we don't do this, okay, we're not going to have anything here, are we? When it comes to variable cost of goods sold. So hopefully you understand, variable cost, okay? If you don't do anything, you don't have any cost, all right? The more units you do, okay, the more costs you have, all right? And so when it comes to variable cost of goods sold, all right, if you do it, all right, you're going to incur $400,000. If you don't do anything, you're not going to have that, right? Then we have variable selling expenses, 65. So we're going to add $65,000 here, all right? If we don't do it, all right, not going to have anything, again, because it's variable. However, when it comes to fixed, all right, if we do it, we're going to incur, all right, this $90,000. Okay. But if we don't do it, we're still going to incur $90,000. Why? Well, because fixed are fixed, right? Fixed has nothing, all right, to do with the number of units. Okay, so whether we do this or not, okay, we're going to incur that. Does that make sense? So hang on, let me add somebody. And so this would be one of those things that is not relevant in our decision-making process, all right? Because they're the same, right? It's like they're two women, all right? This really doesn't matter, okay? And so if we looked at the differential, all right, the total cost of doing this, all right, we're going to end up with, the 465, right? And we're going to have nothing, So our differential costs, all right, are going to be 465. And so if we had differential income of 545 and we subtract 465, we have a positive 80,000 differential income. If it's positive, right, then we're going to do it, right? Option number 1, or A. And so I want you to know, when it comes to the discontinuing of operations and stuff, really this has everything to do with contribution margin. Do you remember contribution margin was sales? Whoa, that's not what I intended to write. Well, contribution margin is sales subtract variable costs. This gives you contribution margin. Now, if you remember, all right, contribution margin, it contributes to covering your fixed costs. Right? In this case, we did not have enough contribution margin to cover, all right, the fixed costs that were allocated, right, to this product, right? Because we had sales, right, of 545 to 5,000, okay, and we had variable costs of 465. We had $80,000, all right, which was a positive contribution margin. If you see that they had fixed costs, right, those were 90. See, we didn't have enough contribution margin. That is why we ended up, okay, with a loss of 10. But if we didn't have this, if we eliminated this, we'd still have that fixed cost of 90, all right, which would mean then we'd actually incur a $90,000 loss, $80,000 more. Okay. And so one of the quick ways to look at this, all right, to determine which one you should do, all right, would be to say, hey, does it have a positive contribution margin? If it does, okay, then do not discontinue that segment, all right, or that product. Does that make sense? All right. The next one I'm choosing is the make or buy decision. Now, I'm choosing this because something that I meant to talk about and I haven't yet is those qualitative decisions, all right, or qualitative factors in our decision, all right? So what we are mostly looking at in this chapter, we're looking at the quantitative, or the numbers. We're not taking into account the non-numbered components of a decision, all right? This one's really good to highlight that, all right? And so in this scenario, we have make or buy, okay? And so I want you to know that there are some decisions where it does not include any revenues, and this is one of them, all right? We're either going to make a product or we're going to buy the product, all right? And so we have two different scenarios here. We have the make or buy. And as I said, a lot of this is just common sense, all right? As if you know, all right, the components. So if we make this, and this is just looking at cost, okay, if we make this, it's going to cost us $230 per unit, all right, including fixed costs, all right, of $47 per unit, all right. And so what we're going to do is we're going to break this up, all right. We're going to break this up into variable costs, because variable costs are generally always relevant, and we're going to break up into fixed costs, giving us total cost. Okay. And so we can see this. We have 230, okay, and they gave us 700. Of that 47 are fixed, right, leaving us 183, okay, that is variable. Okay. And so it says a proposal is offered to purchasing bread from an outside source, okay, for $180 plus, okay, $18, right, for a total cost, right, of what is that? Yeah, kind of pathetic, huh? I can't do that in my head. I can, all right, but it's 198. Too many zeros in my eyes. All right, and so we have a total cost here. Right? It doesn't give us any breakdown because it doesn't matter. It's one price, right? $198 to buy that bread. All right. And so the question is this relevant? All right. Is the variable cost, is that relevant? The answer is yes, right? Because of our variable cost components. If we make it, all right, we're going to incur it. Right? But fixed is not relevant. So we really should not be taking this into account when we're trying to decide between the make or the buy decision. Right? See, this fixed cost is just allocated, right, to our product, right, because fixed is fixed, right? If we make it, we're going to incur it. If we buy it, we're going to incur that. And so it is not relevant in our decision making. And so really what we're doing is we're comparing the differences, right, between these two numbers. Okay. And in this case, what should we do? We should make it. Right? So those are the quantitative components. The qualitative things are really easy to highlight in this scenario also, because if we buy the product from somebody else, we sacrifice quality, right? Because we don't have any control over the quality of the bread that we're buying, right? And also, is the longevity of the cost, right? So, this is what they're charging us now, okay, $198. But what happens next year? Are they going to raise their price? And so we don't have control over that, and so that's a qualitative component. By the way, I actually and I'm sure you guys are doing the same thing. We're doing a lot more baking at home, making breads and things like that, and so I love baguettes. Right, and I was just like, I should make some baguette. And one of my friends, he lived in Haiti, all right, and which is heavily influenced by the French, and so he knows how to make baguettes, and he actually made some baguettes. And I was just like, hey, how do I make it? He was like, just go out and buy it. And he says it takes so much time and energy to make a baguette that's just not worth it. It's just better to go buy them. So it kind of made me fun, made funny of that. But, make or buy. All right, the next one I want to work through is replacement of equipment. All right, and so this is PE 25-4A. Right. In this scenario, all right, it says a machine with a book value of $250,000 has an estimated life of 6 years. It's proposed to, or a proposal is to offer to sell this old piece of equipment and replace it with a new one at a cost of $390,000. Right? The machine had a 6-year life with no residual value. The new machine would reduce the annual direct labor cost, right, from $75,000 to $61,000. Prepare a differential analysis dated October 3rd. Again, the date really is not that important. Onto whether you should continue with the old equipment or replace it with the new. All right, and so I chose this scenario because this is a real life example. All right, and so one of the problems that top management might see, or and this is probably generally more with a like a sole proprietor, where there's just one owner, also founder of the business. All right. And let's say, okay, because we had this old piece of equipment. Let's say that we had purchased, right, this piece of equipment for, let's just say $700,000. Okay. We have, all right, accumulated depreciation, okay, on this thing. What did they say? Right. We have accumulated depreciation of $450,000. That brings us down to a book value of 250. Okay. So this 250 was given in the problem, right? And so here's the scenario. We're actually the IT guy for this company, right? And we're like, man, you know, we've had this equipment for 5 years. You know, it's getting pretty doggish. You know, we should go and get some new equipment. So you do all the work. You find out that, hey, we can go out and buy, you know, some new equipment. It's going to cost us $390,000. All right. So you go into the owner's office and say, hello, Mr. Boss Man. You know, we really need to update our computer software or computer hardware, I should say. And, you know, I found this great deal for $390,000. And so your boss goes, that's, you know, I swear, we just got done paying off, right, the old system. You know, that cost us $700,000, right? Huh, okay, so how long is this new equipment going to last us? And he said, 6 years. 6 years. Okay, how long do you think the old equipment's going to last us? You know, this one that we bought for $700,000. Oh, you know, that could last us another 6 years too, right? So your boss is running through their mind. It's like, why should I drop another $390,000, right, for something that isn't going to last us any longer, right? Get out of my office. You know, you just want the new gadget, all right? So get out of my office, all right? We just dropped $700,000 just a few years ago, and now you want us to drop another, you know, 390? Come on, get out. See, you didn't come in well prepared. You did not come in with a differential analysis, right, to show you the benefit, all right? And so let's look at this. We have the old and we have the new. Okay. Both of them, 6 years. 6 years. So that is not relevant, is it? Okay. So let me ask you, all right, is this $250,000, is this relevant? Okay. The answer is no. Okay. What's relevant in this situation? If we sell that old piece of equipment, we're actually going to have a gain, all right? Because it's told us that we could sell, all right, for 320. Okay. This is sell. Okay. But then we have to buy. Right? Okay. So the selling price is relevant. Okay. But that purchase price, excuse me, 390 is also relevant. All right. And so in this case, I mean, really what we're doing is we're offsetting, all right, that cash expenditure of 390, all right, with the 320. All right. So basically, all right, the net difference is a $70,000 difference, right? So we still have $70,000, right? You know, neither one of them have any kind of residual value at the end, all right? However, when we look at the labor, okay, you know, the labor cost, right, for this old piece of equipment is $75,000, where the new is 61, okay, which is a cost savings of $14,000, right? Okay. And so actually, all right, 14,000, but that's every year, all right? And so we've even multiplied this times 6, all right, the 6 years. We come up with $84,000. Okay. And so this $84,000 can offset that 70,000. And so in essence, we have $14,000 positive, right? If we get rid of that old equipment and buy that new equipment, even if we have to outlay, all right, this $390,000, right? It's worth it. Now, if you walk into your manager's or your boss's office with this kind of information, he's going to say, get it on, go out and get that thing, all right? And so, you know, it's really advantageous in order to lay out the information. Right? The next thing, the next problem I wanted to look at actually is exercise or PE, all right, 25-6A. Now, the reason I chose this one, all right, is there's nuances of each type of problem, all right, and this one has its own assumptions, all right, and so in this one, the issue that we're dealing with is accept a business at a special price, all right, and so with a special price transaction, two things need to be in play, all right. The first thing is we need to know that we have enough capacity to actually produce that. We can't get into buying more equipment or larger building or something like that. We have to have the available capacity in order to produce that product. The other thing is that we got to make sure it does not affect our domestic sales, all right? And so in this problem, it says product AA is normally sold for $120 per unit. Okay. A special price of $112 is being offered, for the export market. Okay, and so we're selling something normally for $120. Okay, and some dude is coming to us and saying, "Hey, we'd like to buy, whatever this is for $112." Okay. In looking at things, we see that the variable production cost, right, to make this product is $80 per unit, and an export tariff, right, an additional export tariff of 30% of the revenue must be paid on all export products. Right? Assume that there are sufficient capacity for this order and prepare a differential analysis dated March 5th onto whether to reject or accept this offer. All right. And so with the information, all right, we're basically saying, hey, this also is a do or don't do scenario. Okay, so in reality, that selling price of 120 really doesn't play into the decision of making this or not making this, right? But that 120, if somebody finds out that we are selling for $112, right, the same thing that we're selling to you or your customer for 120, they're going to be pissed, right? And they're going to want the cheaper price also. And so, again, two assumptions have to be made. We have the capacity, and this special sale that we're going to do is not going to impact, all right, our domestic sales, all right? And so if we want to look at this using our old method, all right, where we had our revenues, option A is sell, option B is don't. Right? And so if we sell, okay, they're asking us for, well, actually they don't do the number of units, but if we sell it, okay, we're going to get 112. Right? If we don't sell it, we're not going to get anything, are we? So the differential revenue is $112. When we look at the cost, sell or don't, all right? Okay. If we sell this, okay, we're going to incur, okay, $80 plus, okay, that export fee, right, or tariff, okay, of 30%. And so, the selling price was 112 times 0.3. Okay. So we're going to have 30%, not 3. All right, we're going to have an additional cost. Oh, I'm sorry, I put that in the wrong spot. Of $33.60. This should have been up there. So didn't do a very good job in writing that anyway. If we don't do it, we're not going to have anything, are we? Okay. And so, if we look at this, we end up with our differential cost. Okay, and so what is that? Eight. Okay. And so we end up with a $1. What is that? Differential income of a negative, all right, $1.06. And so in this scenario, all right, we would choose don't do it. All right, don't do it, because if you do it, you're going to lose $1.60 per unit. All right, so if we did 1,000 units, you know, you're losing $1,600. And so, you know, the issue is don't do it. Now, one thing that in the videos that that I've recorded, you know, in the other scenario, we're selling basketballs, but included in the basketballs is a fixed cost, right? But because that is not relevant in the decision, we would exclude that fixed cost. They didn't talk about fixed costs in this problem at all, right? But because it's not relevant, we would not include that, because it would be the same whether we did or didn't sell this item. All right. Cool. So that's all I really have. You know, the rest of the chapter, or part 2 of this chapter, deals with setting the selling price. All right. Whereas you can, you know, it's a 5-step process. It's really not that hard. Basically, you know, there's 3 different ways, all right, to set a selling price based on cost plus. All right. You need to know that most businesses, when they try to establish a selling price, if it's a new type of business, do a cost plus. Right? A cost plus basically says, oops, yellow. All right. Cost plus is basically saying, hey, you know, you have your costs, and you're going to add to it your desired profit. Okay. And so you're going to mark something up to the selling price. And so really there's 3 different ways to look at this, right? You know, and it's really looking at the costs. Right? And so the way that we, in the example that I videoed, we take the product cost, all right? So we identify, hey, that we had, you know, product costs consisted of direct materials, direct labor, and factory overhead. We need to set a selling price high enough, right, that covers all the additional costs, right? And what are those different costs? Well, you know, this is product cost, right? And so this would be the period plus the desired profit. Okay. And so our markup has got to be high enough, right, in order to cover both the desired profit and the period cost. You could look at it as a total cost, right? And so this would be an example of total cost, right? Again, total cost would be product and period. And then you could look at this as variable, right? You know, which would be, you know, variable costs are on the bottom, right? And then desired profit and fixed costs would be on top, right? And, you know, it's the same process, right, in the calculation. Then I think they talked briefly about target costing, right? And so the idea of target costing is that, hey, you know, we have current, right? We have our cost, right? And our profit. And so these are our revenues, right? But we know that through the passage of time, we have price drift, okay? Which means that, you know, we're not going to be able to sell that, you know, that piece of inventory or product or whatever, the price is going to drop, right? Technological changes, obsolescence, other people entering into the market, all right? And so if we wanted to maintain, all right, our profit margin, we want to maintain that same percentage, okay? What we're going to have to do is we're going to need to reduce cost, right? And so if we can anticipate the decline, right, in our selling price, and as long as we want to maintain our same profit percentage, we're going to have to come up with reductions of our costs. Okay. Then the next area, it looks at bottleneck, right? And a bottleneck is just a constraint that your organization has. Again, I say enough of that in the video. You can watch that. And then activity-based costing. There's really not much on the exam that's going to be addressing that. So you can watch that on the video. So with that, I'm done with my bit, but I want to open it up to any questions that you guys might be having. So let me stop recording.